Hello, everyone, and welcome to Currency Exchange, a NatWest Markets podcast series all about foreign exchange markets. I'm Brian Daingerfield. I'll be your host today. And G10 FX markets continue to be dominated by developments in Iran. The back and forth continues between escalation threats and the possibility of de-escalation. That continues to create a lot of uncertainty in markets, maybe not as much FX volatility as we had at earlier stages in this crisis. But as we think about FX markets going forward, in the coming week, we have tons of central banks coming up. And so we're going to have a lot of opportunities to see if central bank reaction functions have shifted at all, given the big moves in energy prices and the big uptick in uncertainty. So to talk about all things FX markets, as always, I'm happy to be joined by Paul Robson, who co-heads FX strategy with me and NatWest sitting in London. Paul, thanks so much for joining.
Well, as ever, Brian, thanks very much for the invite to this week's currency exchange. Like you say, it's big focus on central bank reaction functions for US and Iran developments. And I was just wondering what your latest thoughts on that and what you think about the implications for FX.
Yeah, so I think the market continues to be effectively paralyzed by developments here. It is just so difficult to get a read of the situation in the immediate term. There are periods when it feels like the market is leaning towards de-escalation and trying to price towards better outcomes for global growth, lower oil prices, and a weaker dollar. And then you have periods where the market is more focused on the risk of escalation, and you're seeing bounce backs in the dollar, you're seeing lower equity markets. And frankly, I think this has created a situation where positioning across markets is very light, conviction is very low, and we don't see a ton of optimism or opportunity necessarily for markets taking strong directional views. I do think if we're trying to think about where the market is in terms of expectations for escalation versus de-escalation, certainly feel like the market is leaning in the direction that the worst of the conflict might now be behind us, with the belief that the ceasefire being extended multiple times, the fact that the ceasefire hasn't been violated in a major way, that minor violations have been met with more jawboning than direct action. I think that has the market leaning in a more optimistic direction. But that certainly is something that's held with a sense of cautious optimism that, I don't think anyone's under the illusion that that sense of cautious optimism can't be overwhelmed by a big change in conditions on the ground. So as we record this, the market is certainly looking for evidence that new talks, a second round of talks in Pakistan between the US and Iran might take place. Right now that is on hiatus, but I think the market is trying to trade this somewhat optimistically. And what we've seen in FX markets is, in some cases, a rebound back in risk-sensitive currencies. The dollar is effectively the middle of its range. The trade-weighted dollar is effectively at the middle of its range that it's been so far in 2026. I think that the fact that the dollar and the G10 basically being at the mid-range is probably contributing to the sense of a lack of directional conviction, certainly both from me and I think from the market as a whole, that it's hard to get super excited about the dollar directionally when there's massive two-way directional risks coming from the Iran war, and the fact that you're not really on the extremes of the range, instead you're basically in the middle of the range. All of this, I think, leads into the market trying to figure out this, the short term and, trying to be sensitive around the significant uncertainty in the short term, but still FX markets having seen a big turn down in volatility. But, as we look ahead, one of the things that we have certainly focused on, Paul, in these discussions is some of the more medium-term ramifications that, we have to be considerate of the immediate term back and forth between these two nations and the possibility of further supply disruptions. But as we try and move away from some of that headline volatility and think about medium term, one of the big ones that we keep coming back to is, how are central banks, how are monetary policy, how are front-end rates taking these developments? Certainly in all cases, we've seen big hawkish shifts in markets. And as oil prices have come down, some of that has gone away. But still we see central banks at the moment, the way they're priced in markets, are at a much more hawkish posture than they were before the start of the war. Now we have a bunch of major central banks coming up in the week ahead, and I want to start and bring you in here just to talk a little bit about the Bank of England. How are you thinking about the Bank of England next week as they're going to juggle, just like everyone else, all of these differentiating factors with Iran and also local developments?
Yeah, I think it's a very interesting position that the Bank of England finds itself in. As you say, the longer the crisis or conflict goes on and the oil price stays high, the macro impact is going to be greater. And for the Bank of England, they've been in no rush to react. They want to see how the conflict continues and the impact, because the last thing I guess the central bank wants to do is tighten unnecessarily, and you lose output, and ultimately you drive inflation below target. So they're very much in a wait and see mode, and I think that's what the April meeting, next week's meeting, will be about. It will be a bit of a placeholder. We think we'll get a 9-0 vote in favour of keeping rates unchanged at 3.75%. There's always a chance that you get a hawkish dissent of one member, but that's not going to be representative of the balance of the committee. And there's always a risk that a couple of the doves who have been very dovish through the last year or so vote for a cut. But we think on balance that you'll get a 9-0 vote for unchanged rates. We've actually had a lot of speakers over the last couple of weeks. Got the IMF meeting that sort of increased the number of speeches, and with each speech you get a little bit of understanding about the Bank of England's guidance and bias in terms of policy changes going forward. And there we think the guidance will be unchanged, that they'll do everything that is necessary to get inflation to target. They have a 2% mandate. They probably need to have a little bit more clarity around the guidance, because at the last meeting where the guidance was for that, sort of doing everything that they can, you actually got a really big move in front end pricing. And I think that they would have been shocked by that. I think in reality, I think a lot of that was position related. I think a lot of people thought interest rates were going to go down. We thought they were going to go down, but some people thought they would go down a lot more quickly. And when you had the crisis, you got a snapback. They've done a lot of sort of guidance tweaking over the last couple of weeks. So I think markets are in a relatively good position. You are actually getting quite a lot of volatility, though, continued at the front end of the curve. And I think it's one of the interesting things is that currency markets remain relatively becalmed in general, but you've still got these positioning risks in the front end. I think the more important meetings will come later on in the year. So NatWest economists think we'll get a rate hike of 25 basis points at the end of the year and a follow-up one at the beginning of next year. I mean, that's their modal case because they don't hold those two hikes with 100% conviction. And if you work out sort of average mean, they're more likely to be looking for about 35 basis points, which until a couple of days ago was broadly in line with markets. But all of a sudden, markets have got two 25 basis point hikes by the end of the year. So I think where markets might adjust with guidance is those rate hikes come later in the year, whereas markets seem a little bit more confident they come in early summer, not into the winter.
Yeah, thanks, Paul. I think two things you said really stand out to me, which is number one, if their guidance can avoid the massive moves that we saw at the last meeting, then that could be considered a success. And I feel like they're pretty well positioned for that, considering, to exactly your point, the idea that this is a placeholder meeting, I think resonates really well with me. And then the second one is exactly what you said around the volatility, and the volatility in front end interest rate markets has been so much more pronounced than it has been in the currency. So I do want to bring you back here to the currency, and we've talked about quite a bit in these podcasts about sterling and its, call it, relative resiliency through this period. How are you thinking about the currency here as we're trying to think about this volatility in other markets that just doesn't seem to be feeding into FX markets and into the sterling?
Actually used the word I was going to start answering that question, this idea of sterling resilience, because I think there would have been a view that sterling would struggle through another energy price shock, because an energy price shock impacts for a number of ways into FX, and they all play to sterling's vulnerability. So the UK is a net importer of oil. You've got the fiscal vulnerabilities that will be exacerbated if the government seeks to help parts of the economy safely navigate the sort of higher energy prices, both businesses and certain households. You get further weak growth. Again, that sort of challenges the fiscal outlook. And of course, you've got this Bank of England reaction function. I think for sterling, it's a case of once you've gone through all the reasons why sterling may have gone down, but it hasn't, then you just are left with a couple of reasons why it stayed relatively resilient. And for me, it must be there's some kind of underlying positive capital flow into the UK. And the UK has some, or some people would say many vulnerabilities. It is can be a relative safe haven if the UK is keeping its distance from the Middle East. And of course, the UK has had very good links with the Middle East for decades. And I think there might have been some kind of related flow. It may well also be that just signs of the dollar, maybe capital outflows from the dollar. Again, it's really hard to really get evidence of what flows are happening out of the US. But I've certainly noticed, and maybe I'll come to you when we talk about the Fed chair and the testimony and things like that. But the idea, the dollar seems to be getting less support from escalations than it used to, and that seems to be under more pressure than it used to be on good news. And I wonder whether that's part of the story. But I'm not sure those flows can keep the currency elevated for much longer. And I think ultimately politics and fiscal policy are the key risks for sterling, which I think will come back. Maybe not in early summer, but maybe we have to wait for the autumn. And there I mentioned that we saw that Walsh was giving his testimony in front of Congress for his candidacy for becoming the chairman of the Fed. Just thinking what your thoughts of the impact for the dollar.
So, Paul, I definitely want to talk about Warsh's testimony and what we heard from the potential next Fed chair. But you said a couple of things on the dollar that really piqued my interest. I want to sort of echo on, which is number one, the lack of escalation, upside pressure more recently, and maybe more sensitive to the de-escalation. I mean, you and I were both in the market covering currencies back in 2022 when the Russia Ukraine war began, and the moves in the dollar at that time were so much stickier and so much more persistent. You think about euro dollar having moved from, I think it was the low one teens all the way down to parity and below, reflecting these shifts in relative growth expectations, similar themes, much larger currency moves. And I think about that with the dollar and the US economy just not being in the same position as it was during the last big energy shock, that the labor market is just not as strong. The case for, the one-way street of flow into the US economy, into the US market, I just don't think is as strong as it was. The dollar just does not have the same exceptional varnish that it did back in 2022. And I think that's really reflected in these the fact that we have oil prices still significantly off their lows, no material change in Strait of Hormuz in terms of supply risks, relative growth expectations have shifted in favor of the U.S., broadly speaking, and yet the dollar index is basically unchanged. I think it does reflect some of those larger factors at play, that the U.S. is just not in the same position as it was, cyclically as it was. And this theme of de-dollarization, this drumbeat of de-dollarization is a longer-term theme. Certainly feels like it's on hiatus at the moment, but I don't think it's gone away in a material way. I still think that's an important factor. Now, let's talk a little bit about Warsh. I think this week and next week with the Federal Reserve, a bit of out with the old, in with the new. We're hearing from Warsh this week, and we'll hear from Powell in what could be his final meeting as chair from the Fed next week. The big question for Warsh is, will he come in and put his stamp on the institution with dovish policy on rates immediately? And I think Warsh said a lot of the things, he said a lot of the right things in this venue when he was facing the Senate, because the number one thing he had to do in front of Congress was to stress to Congress that he was not going to come in and do exactly what the president wants him to do on policy. If that was his main goal, mission accomplished. He certainly pushed that narrative forward about Fed independence. He said what I consider all the right things on that front. But when you think about the other pieces of his testimony, a lot of the dovishness that we expect from Warsh was very much there, talking about how you can think about changes in the way the Fed is thinking about inflation, things like looking at alternate measures of core inflation, which in some cases are maybe giving you a more constructive picture on inflation than the indexes that we more commonly look at. That to me was a dovish concession. This idea that he thinks inflation is still on a good track, also a dovish point of contention. I still think that his overall view on policy is that deliberate, slow, but meaningful change in the balance sheet policy over time, moving towards a lower balance sheet over time, is something that could unlock additional stimulus in the front end of the interest rate curve, basically taking away stimulus from the balance sheet and redeploying that further in on the curve. And you take all of that together and say, still think this is a chair when you add in the possibility of them thinking about AI productivity, Warsh thinking that that's a source of disinflationary growth. I see a lot of the kernels of dovishness that we've long been expecting from Warsh. What you didn't really get the sense of was urgency. And of course, Warsh didn't want to preview any of those decisions, but I certainly get the sense that Warsh is going to come into the Fed arguing pretty strongly that rates do not need to be as restrictive as they are. Is he going to be successful in that in his first meeting? We don't think so. The market certainly doesn't think so. We basically priced out all Fed easing for the year. We do think that his ability to influence the Fed is going to get better over time, and that we are going to return to rate cuts by the end of this year. But I didn't hear anything from Warsh that makes me think that he's going to be a much more hawkish individual when he comes to the Fed. If anything, I think he said a lot of the things he needed to say to Congress, but a lot of the kernels of dovishness, I think were certainly there kind of in the subtext in the way he was talking about growth and inflation and the possibility of non-inflationary growth.
Yeah, that's all very clear, Brian. It feels like we need to jump back from the future to the present. You mentioned that we're going to hear from Powell next week, but the Fed, we've also got the Bank of Japan. So it's also going to keep us busy next week in terms of central banks. But just wondering how you think those two central bank outcomes will impact foreign exchange markets.
I think all of these meetings are still secondary to Iran. Let's just give that concession at the top, that the markets will be more than willing to discount what Powell and the Bank of England, the Bank of Japan, what everyone says if there's a big change in the steady state in Iran. Let's just put that to the side and say that's where we are in markets right now, given the significant uncertainty there. But you mentioned the Bank of England as a placeholder meeting for next week, and it feels very similar with the Fed. This one is not a new, this is not a new SEP meeting, no new dot plot this time. And depending on how Warsh's confirmation process goes, given the inquiry into Chair Powell, this is possibly Powell's last meeting at the head of the institution. And I don't think he's going to say a lot that we haven't already heard, which is basically, what he said at the March meeting was, we are currently dealing with two separate inflation shocks that we don't really know their impact and duration, layered on top of each other. The first one being on the tariff side, the second one being on the energy side. And I don't think we're any closer to clarity. Maybe on tariffs we're a little bit closer, just the distance of time between when we had the big implementation of tariffs and now you get a little bit more clarity. But of course, you have still some uncertainty around where ultimate tariff levels will fall. But maybe you have a bit more clarity on tariffs just because you have so much distance between Liberation Day and April of last year. On energy prices, we just still don't have really any clarity, although you've seen certainly oil trying to carve out a more narrow range here, certainly a lot higher than levels that prevailed before the start of the war, but still well off the highs in terms of front contracts, for example. And so what Powell said in March and what the Fed's position was in March was, there's confidence that services inflation is probably going to continue to come down because the labor market has not been, suggesting that wage inflation is picking up and that job demand is high. There's been so much volatility in monthly non-farm payrolls prints, but the overall picture is one still, the labor market that I think is in a fragile balance, that supply and demand for labor has come down. And so what Powell said back in March was basically, we think we're in a good position and we have time to wait and see for if these are going to be temporary or more permanent impacts to inflation, and the labor market is not in such a bad position that we need to be in a hurry to ease. And I think he's going to continue to keep that message as the broad, if this ends up being his swan song, he leaves the committee in a very similar position where we were last month in terms of his final press conference. And so I think the market is going to have to try and balance those differentiated messages between the current leader and the future leader of the Fed. One, I think, who's going to come in with a view of we will have the ability to look forward and see an outlook where inflation is lower and could potentially respond to that now, versus how Powell and the center of the committee, I think, will try and put it now, which is we're just in this good position. I think the market is pretty well prepared for that outcome from Powell next week. The Bank of Japan is certainly more interesting because it certainly felt like there was a case to be made for the Bank of Japan to hike the policy rate at their April meeting. It looks like local media have kind of been pushing in the direction of them not going this week, instead maybe favoring a hike at their next meeting in June instead because of the uncertainty in the Middle East. So we ourselves, in response to that, what looks like effectively signaling from the Bank of Japan, our economists updated their call expecting the next hike to not come at the April meeting now. And for the currency markets, I think this is a disappointment. We had already priced down the risk of a hike relative to, it was kind of 50-50 at the middle of the month. It's come down a little bit from there. So it's not to say that the market wasn't already wary of this risk. But for a long time, the yen, one of the reasons why the yen has been under so much downward pressure is because they have negative real interest rates, very low nominal interest rates, and the Bank of Japan has shown a reluctance to step up in a very hawkish way to raise interest rates to defend the currency effectively from whether it be from speculators or to defend inflation from imported risks, risk from imported inflation, including a weaker currency. And so I think this is going to be another meeting where the Bank of Japan is going to, talk a wait and see, keep the door open for hiking the policy rate. But, this is going to be the fourth or fifth meeting in a row now where the Bank of Japan has said, we think the conditions for rate hikes is going to come into play at some point, but we're just going to stay cautious here. And I think that's something that, the market has been looking for the BOJ to be more active, more hawkish, specifically to defend the currency. And this looks like another opportunity to do that the Bank of Japan is going to eschew. Now, there's good reasons why you might do that. There's serious growth risks in Japan. Equity markets are rallying in Japan. If you were to hike interest rates, that could create new volatility in JGB markets. It could reduce equity markets. And the Bank of Japan is, of course, very focused on corporate profitability, corporate's ability to sustain a period of energy uncertainty. Higher equity markets maybe help with that case. So you could absolutely make the case for why it makes sense to hold off here with everything going on with U.S. and Iran. But the Bank of Japan has been telling us for months they've been waiting for evidence on wage inflation from Shunto wage rounds, the critical wage rounds. That evidence is in, and it's pretty good. You have wage gains that have mirrored last year's pretty elevated levels. If you look at the Tonkan survey, which is a pretty important survey of businesses that the Bank of Japan does, in the first quarter, most of that was higher in terms of expectations for current and future expectations for growth from small and large businesses alike. And so I think the case for hiking is clearly there. Obviously, the volatility is significant. It looks like they might be leaning in favor of let's wait another month. For the currency, I think that's another sign that the Bank of Japan is not necessarily stepping up to defend the currency. And I think the markets might take that negatively. Now, we're on the precipice of a breach of 160 in dollar yen, which we know is a level that the Ministry of Finance has previously intervened at and has made it very clear that they might jawbone the market very significantly. So I think that risk has been one of the reasons why dollar yen has really struggled every time it's kind of tested 160 in this period post the U.S.-Iran war. That intervention risk feels quite high, if we do see that breach of 160. But one thing that we'll be watching is if you do get a rate check in dollar yen or you do get intervention, is whether or not Treasury and the New York Fed on behalf of Treasury might be there in the background, maybe acting to help the Bank of Japan in this effort to strengthen the yen. Because last time we have a confirmed rate check in dollar yen back in January, the New York Fed actually engaged in a rate check as well, which is highly unusual and was quite positive for the yen at the time. What we felt at the time, what looks to be the case certainly now, is that the reason that the New York Fed opted for Treasury did that, and New York Fed did that on Treasury's behalf, was that Treasury was worried about the impact of Japan fiscal uncertainty and yen weakness filtering through into long-term JGBs, which was weakening long-term treasuries. I don't think Treasury, when they decided to do this rate check, I don't think they were thinking, let's do a good thing and let's help out our friends in Japan. I think they were thinking quite selfishly here. And they were saying, this yen weakness, this JGB market weakness is causing uncertainty in our long-term interest rate markets that's hurting us in the US. And we can take a low-cost step to maybe reduce some of that uncertainty and maybe reduce some of the sort of spillover risk from Japan uncertainty into the US. You just don't have that now. Japan fiscal uncertainty is not really having a material impact on US markets. Let's say, for example, in a hypothetical scenario where the Bank of Japan does step up and step in with intervention on behalf of MOF, I think the markets will quickly be asking themselves, hey, is Treasury behind them? Is Treasury coming in right behind them? And I'm worried the answer to there might be no. So I think that's going to be an important one to watch. If we do get into this scenario where if the Bank of Japan is more dovish than expected, dollar yen does breach that level. And I think that's an important dynamic to watch as we're thinking about the possibility of intervention coming in to potentially support the yen in that weaker yen scenario. So we've covered a lot of ground here. Paul, thanks so much for joining. This is a really good conversation ahead of what I think is going to be a really busy week of events. And of course, we'll always be watching the headlines and the latest coming from potential US-Iran talks. And to our listeners, thank you so much for listening. If you enjoyed today's episode, please consider giving it a like and also subscribing to the channel so you can get our latest content the moment it's released. Thank you so much.